Strike three call.
On San Diego's #1 sports station, 97.3 The Fan.
This program is sponsored and produced by Wilsey Asset Management. Opinions and offers expressed during this program are not those of Intercom Communications or 97.3 The Fan.
Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, good morning and welcome to the Smart Investing Show. I am Brent Wilsey and thank you for joining us this morning. I've been doing the Smart Investing Show here in San Diego on local radio for 27 years. Now, if you have investment questions or want a fundamental analysis on a stock you own or are looking at buying, selling, or holding, please call in at 833-288-0973. Again, that number is 833-288-0973 for that unbiased, no strings attached, fundamental opinion about what you want to talk about. Well, good morning, Chase. How you doing?
Good to be here.
Always good to be here on Saturday morning on our new station here, and love doing the Smart Investing Show again. Been doing it for a long time here, and we always take calls. But we got some things we got to talk about this past week, as we always bring up in the beginning of the show. Let's start off with Tesla stock, and you and I don't agree with Elon Musk very often, but he said some things like, "Wow, we agree with that."
Yeah, it's been an interesting week for Elon. He's, of course, kind of a off-the-chart CEO, I guess is the way I would put it.
That puts it very calmly.
Yeah, and I mean, he's a very interesting guy. But, he came out and talked about the stock price, and we've, been in the camp for a long time. Tesla stock makes absolutely no sense. And this week, the CEO, Elon Musk, comes out and says the stock price is overpriced, or it's too high, in his opinion. Very, very unusual. And it's especially crazy because he's always been, Tesla's going to do this and do that. But to be in the camp saying, yeah, my stock price is too high, you have to wonder, how can these analysts and these new advisors and these different investors actually justify some of these price targets that are, 3,000-4,000? Yeah, you've seen some of these that are actually
I think
crazy.
It was 10,000.
It's just like, how can you justify that price target when even Elon Musk now says the stock price is too high?
And I think part of it was he is a little bit frustrated as well. He's selling his homes, and he's really frustrated with what's going on in the country, in California with this whole shutdown. He is a big believer in freedom. I mean, that's why he's from South Africa, I think.
I think South Africa. Yeah.
That's why a lot of people from around the world came to this country because of our freedoms. And now we're acting, I don't want to get too political here, but we're acting kind of like a communist country where, no, you got to stay in your homes. No, you can't do this. And I think people like him are very frustrated because they believe, like I do and you do, a lot of people do, in the free society. So that's been taken away. So I think he's kind of frustrated.
Yeah, I think he did go on kind of a tweet storm, and I think he was just throwing out a bunch of different stuff.
Yep.
But I do have to agree with him. His stock price is high. I mean, we did look at the fact that the stock still trades at over 100 times next year's estimated GAAP earnings per share. Again, the long-term average is 16.2. And then, gosh, I did some math on this, and it is just unbelievable on what the company is trading for if you compare it to all these other businesses.
Oh, yeah. I mean, they got a current market cap of $130 billion. Now, that now exceeds the combined market cap of Ford, General Motors, Fiat Chrysler, Lyft, PACCAR. Now, PACCAR builds Peterbilt, Kenworth trucks. Navistar, another large truck manufacturer. Borg Warner provides engines and drivetrain solutions. Cooper Tire, Penske Auto, which operates automotive and commercial truck dealerships, Advanced Auto Parts, and CarMax. Now, that's a long list.
I was going to say, it sounded a little winded there.
Yeah, I take a breath because it's so much. And we try to put things in perspective. And I'm not saying the car is a bad car. It's a great car. But whenever you invest, you've got to bring things back down to reality, what it's really worth. And, yes, I think this company will do well going forward. There was a time we thought that they could go bankrupt. I think that could be off the table for now, but the stock is not worth what it trades at. And it could pull back, especially when your own CEO says it's overpriced.
Yeah, well, I to be honest, I think they're in the clear on the bankruptcy. They've definitely been able to take advantage of investors that believe in their cause. And most of the time when companies issue stock, that stock price goes down. Not Tesla, it goes up 10%, when they issue stock. So they've been able to raise capital, unlike many other businesses, which I think is going to get them out of the bankruptcy type issues that we believe that they would have had. But yeah, as you said, very, very expensive, because we did look at all those other combined companies. The sales for all those businesses last year were $508 billion. Tesla's was $24.5 billion. So I mean, it just really blows it out of water if you again look at the numbers here and say, why in the world is anyone buying Tesla? And again, Tesla may be at, I don't know, $100 a share might make sense. But, to actually look at it in this regard, it's just saying, gosh, this thing is just way, way too expensive.
It is crazy. And again, great company, great car, but you as an investor, and that's what we do, we talk about investing, you have to look at what you're paying for a business. And also, too, you talk about how they can, issue new shares to pay out the debt. Well, people don't realize about the dilution they're having of those future earnings, because your earnings could be down the road, I don't know, they could have been maybe a dollar or two a share. Well, if you, increase your share outstanding by 20-30%, you're not going to get that dollar to a share. And eventually, this business, like other businesses, will come back down to what are you getting for the earnings and how much are you paying for those earnings.
Yeah, I just wanted to add one thing was, I always think it's funny, oh, Tesla's not a car company. That's what people say, not me. I'm pretty sure they're a car company. They make cars.
Well, and also, too, we had a question this past week that you and I were asking, like, well, wait a minute, why is Ford and GM, they've got to deal with the UAW, the union? Yeah. And why does Tesla does not? Now, the UAW is trying to get in there because they are a car company. So that's where they make most of the revenue from. They're a car company that uses a lot of technology to drive their car, but they're not a technology company, they're a car company.
Yeah, so, and GM and Ford are starting to use more technology, so now can you beg the question, those are technology companies? I don't think so. So I think more regulation for Tesla down the road is definitely going to upset Elon, but it's also going to add to, costs and hurt earnings. I think it's an exciting stock. It's, I've always appreciated the manufacturing and the technology side behind it, but just as an investment, gosh, it does not make sense. And you could trade it. You could maybe make, 50% trading it, but it is just crazy. You're going to lose your shirt. You're going to go absolutely insane if you do trade it over time.
Exactly. So a lot of people talking about, how bad things are and, excuse me, how long it's going to take to recover. Gary Kelly, who is the CEO from Southwest, brought up a good point this past week when he talked about their earnings, that this is like the roaring 20s. It was a process time for a company, and that followed the 1918 Spanish flu. So, I mean, you're going to have these periods. It's so funny. Do people really think that we're going to have continuous growth year after year after year for forever? Of course not. I always talk about the 7 to 10 year business cycle. It's been just about 10 years since we had the 2008-2009 debacle here, and now we're going through something else. That happens in the economy.
Oh, absolutely. And the thing that I think people misinterpret is, what is he seeing? Things are crazy right now. And he came out and said, in the short term, and this is the problem with a lot of Americans, a lot of people, is they're emotional. They can't look past a day. They look at it, instead of saying, there's no way we get back to normal. There is a way we get back to normal. And again, he pointed out, in June, July, air traffic is still going to be struggling. It's going to start recovering, but it is not going to be what it was. And then he said, you can't forget, again, the Roaring 20s was one of the most prosperous times for our nation. Right. And that came after, in my opinion, the Spanish flu, far worse. Now, I'm going to do a post probably next week on the Spanish flu and all the numbers behind it, because it was actually a terrible, terrible time for this country. Very, very scary. By the way, we never got a vaccine for the Spanish flu until years after that crisis ended.
And I've talked many times, too, is that think now, 100 years ago, it's about when it was, 100 years ago, the advancements from 100 years ago in medical technology and drugs and everything. I mean, you can't compare 1918 to now. It's a whole different ballgame. So it's just something you have to kind of look at.
And the reason we did point out that post was just because we wanted to say, people say, I'm going to be so scared and, I'm going to be cooped up for a long time. Again, people got over that fear of going out and contracting the Spanish flu within a couple of years. So we could, again, see a prosperous time ahead within the next few years. Again, it's not going to change tomorrow, but things will progress. Things will get better.
Yeah, things will get better. That's the important part. And people say, oh, it's going to take 5 to 10 years to recover from this. It will not take 5 to 10 years to recover from this. The quicker we reopen the country, the quicker we will recover. I was on a national program yesterday talking about that. We are ready to go. There's a lot of money on the sidelines. People are still getting paid. They're getting that $1,000 a week unemployment. They have money to spend and no place to spend it. If the governors would reopen our economy, we could get back to a boom very quickly. And also, we had Gilead, their drug passed the FDA. There's progress.
Well, they're used as an emergency drug now, yeah.
But still, emergency drug. Last week, had Johnson & Johnson said that they could have, I believe, also on an emergency basis, a vaccine by September, perhaps. So there's so many things developing in the drug world, and that's what has to happen. You know what we need to do? We need to cut out the media, because the media just scares people. They always look at the negative side, not the positive side, and that's why people are so afraid that, oh my gosh, I'm going to die. And we've talked about how low, and not just us, but from scientists and from doctors, and kind of get off track here a little bit, but the scientist from Stanford, who's the 100th most quoted scientist in the world, how he's saying mortality rate is too high.
Well, I was going to say, we can move on to that probably. We did have that kind of data there. You brought it up, might as well talk about it. But I, again, do want to point out, people keep saying, well, you say that things are going to recover quickly. I just can't harp on it enough. We will not go back to where we were on January 5th, let's say, tomorrow. If we start to reopen the economy, it's going to be a climb forward. It's not going to be a quick reversion to where we were. But there is a lot of money in the economy, as you said. There will be people spending that money. But again, I do want to point out, it's not going to mean we're going to have positive GDP for 2020. I think you'll still see a very low single-digit GDP decline is my opinion for 2020.
Yeah, it depends on how soon that these states get to open up, because I think we could have a positive GDP, very, very small one in 2020, but it really depends on the states. If the states are keeping their states closed until June, July, I've even heard of August, you're not going to have a positive GDP. But if these governors wake up and realize that, wait, things aren't that bad, things are going okay, and I just...
We just need a plan moving forward because, and again, it doesn't mean open up everything tomorrow and, flood the economy. It just means we need to have some type of plan to test the opening of the economy is what we're looking for.
Exactly. And what I was going to say, too, is that what happens is that it's going to build. You're not going to be doing 100 miles an hour right away. You're going to build up to that. And that's going to happen as they open it. People are going to start going out and things are okay. And, well, gee, it's been 2-3 weeks now. Well, everything's okay, so I think I'll start going out. So that'll be the growth. So as you said, I kind of jumped ahead a little bit to the science from Professor John Loannidis. Is that what you say his name? Loannidis?
I don't even know why you went for it, but it's an I, so it's Ioannidis.
Ioannidis. Okay, there we go. I thought it was an L. Okay, so, but yeah, again, people keep saying they got to listen to the science in this pandemic. Well, here's a gentleman, as I said. He's a professor from Stanford School of Medicine who is ranked by Google Scholar as one of the world's 100 most cited scientists. Not the United States, but the world's. And he had some interesting points. Now, his study looked at blood tests of 3,300 volunteers in Santa Clara County, and they estimated from estimate of 2.49% to 4.16% of the population in the county had been infected.
Yeah, and the crazy thing is that the total cases then would actually exceed the confirmed count by about 50 to 85 times. So again, I keep talking. I think the confirmed cases number that you see, I don't want to say that number's not important, but it's really not showing of how many people have actually had this virus now that we're starting to see the blood tests come back. I like to kind of look more at the hospitalizations and the deaths, because those, in my opinion, are harder numbers, where those are the people that are going to the hospital, that are passing away, unfortunately, from the disease. I think it kind of gives you more information. And the reason we point this out is because if you actually look at the fatalities compared to a estimate of 50 to 85 times higher on the confirmed cases, the fatality rate would actually be between 0.12 and 0.2%. Negligible compared to what we see at the 4 to 5% rate currently.
Right. And also, too, what I like to, and again, I know there's people going to argue with this. That's okay. We're just giving the facts from a scientist. And also, this is you talk about a power couple. I mean, his wife is also an infectious disease specialist, also at Stanford University. So you've got two very smart people. They found in Italy, people under 65 without underlying conditions accounted for 0.7% of the coronavirus deaths. In New York City, that number was just 1.8%. So again, you've got to really understand the numbers. And you said a good thing the other day that, no, we're not doctors, no, we're not scientists, but we understand numbers. And that's the important part, to understand numbers. And why do we care about this? Obviously, we care about this because we're investing in businesses. We need the economy to open to have our businesses do well.
Well, and if the businesses don't do well, then the economy's not going to do well. People will be unemployed. It'd be terrible. I mean, we talked about that the other week. And, I just kind of keep saying is, think about, as we pointed out, with the deaths from those under 65 without underlying conditions, and now potentially an increase in the number of confirmed cases, so a lower mortality rate, plus the people that are under 65 that aren't passing away without underlying conditions. I mean, you're talking about a mortality rate for those people that is negligible. I mean, it is going to be so minimal for, somebody like in my age group, or even somebody in their 50s that is healthy. It's going to be very, very, very small.
Right. And it is very important to kind of look at this stuff and understand what's going on. But again, it brings down, hopefully, the fear factor where people get out and start consuming again. So let's go ahead and open the phone lines. What's our phone number here? 833-288-0973. Again, that's 833-288-0973. And as always, that gets you through for your unbiased, no strings attached, final opinion about what you want to talk about. Well, Chase, one thing, too, that I do want to kind of pull back in here as well is that the decline in stock prices of big chain restaurants, because they've been hit tremendously. And I kind of get excited a little bit when I see some of the declines in the stock prices of some well-known big chain restaurants like Cheesecake Factory, Darden restaurants. And again, as we've been saying, I do believe that people get tired once again of cooking at home. I mean, it's a great thing to begin like, oh yeah, it's so great, we're gonna do this, we're gonna do, have this new recipe and so forth. After a while, it kind of gets old, especially you got to clean up the damn dishes. And I hate cleaning dishes. I don't know about you.
Yeah, it gets a little bit annoying, I guess, is an easy way to put it. And, I've talked to so many friends here, and that's the number one thing we're talking about. It's like, gosh, I miss going to restaurants and just being with your friends. And, it's been fun. I've been, just kind of learning how to cook different things. It's been interesting, but I'm ready to go back to the restaurants and, and go enjoy, and not even go to the restaurants, because I've still ordered takeout and stuff, but just the atmosphere. It's a fun atmosphere that you kind of forget about.
And I think they can make it look pretty good, because they're talking about maybe having like plexiglass between the booths and so forth. I mean, just imagine with the right lighting. I mean, it could actually make it look kind of cool, because it'll reflect off of the plexiglass, and you can make restaurants safe. If you're waiting, don't wait in the lobby, wait in your car. They can call you from your car. There's things we can do to have the restaurants reopen. The thing is, I just think it might be a little bit too early to start investing into restaurants at this point in time, because it's just too much uncertainty at this point.
Yeah, I agree with that. I mean, I like, Cheesecake Factory. I love cheesecake, so I think it's a very interesting company. I've looked at it a few years ago. They had some interesting numbers, and I do believe they're kind of a little bit more unique. A lot of these big restaurants, they actually use franchises. I believe they own their restaurants. I could be mistaken on that.
I don't know. I can't answer that either.
Yeah, because when I look at their balance sheet,
there's a lot of them.
Yeah, there's a lot of them. But I know there are a couple restaurant chains that actually own their restaurants rather than franchise them out.
Right. And one of these days, I'm going to start to where I want to try every single cheesecake that Cheesecake Factory has. And not in one day, obviously, but they got, 100 different ones. So it's just something unique you want to kind of get back to. And also, too, I think we're going to see, too, perhaps in the restaurants, we may also see temperature checks. I've even seen perhaps silverware sealed in plastic. So many things they can do to get back. We just need to let America back to the ingenuity of creating things on how to solve this.
Yeah, no, I completely agree, and I did want to go back to Cheesecake Factory, because I did just look it up real quick. They do not franchise. They are all company owned and operated.
Did you say how many there are?
No, I didn't look that deep into it. I just kind of headline looking at it, but they company owned and operates all of it. The reason I like that is because a lot of times with the franchise model, the company is what's known as asset light, and it really complicates the balance sheet. So it's very, very hard for investors to actually look at the debt-to-equity ratio, because the debt-to-equity, there's very little equity because it's all franchise-based or asset light. Very hard to understand. I like Cheesecake Factory because their balance sheet was a lot cleaner. I do believe that, when we come back from this, companies like restaurants could be a great place to invest, but just be a little bit more patient, as you said.
Yeah. Great place to invest and great place to eat as well, I think.
Yeah.
All right, so phone numbers here, 833-288-0973. That's 833-288-0973. Let's go out to Coronado and speak with James. James, you're on the Smart Investor with Brent Chase. How can we help you?
Good morning there, Chase and Brent.
How you doing?
Good, thanks. Good. Listen, you guys have reviewed Phillips 66 in the last couple times in the last month. PSX, they have a partnership, PSXP, that I'd like your comments on. I'm thinking about it, but I thought I'd wait until I heard your comments on the PSXP.
Okay, well, let's take a look at and I do see that's Phillips 66 Partners LP. The symbol is PSXP. Darn good start here. PE ratio 8.5. Nothing for the industry. Price to sales, now that's very expensive, 8.4 versus 0.3. Price to book value, 3.6 versus 0.18 for the industry. And price to cash flow, well, that's 11 versus 1.4. So the valuation ratio is looking pretty high except for the PE ratio. Now, I do see you got a good dividend here of 8.4%. They only use 69% of their earnings to pay that out. I do see that the sales growth year over year up 8.1%, well above the industry at 2.4. Earnings per share was up 21.6. Industry down 59%, so that's a big positive there. The balance sheet, a little bit of worry here. We got a current ratio of 2.1 versus 1.7. That's okay. What I see that I don't like is the debt to equity is 124 versus 78. So I want to understand what that debt is and also too what their equity is as well, because that's a little bit high, makes me feel a little uncomfortable with that high debt to equity of 124. Return on equity is 28.9 versus negative 21.7. Net profit margin, crazy number here. You got to understand this one, 81.5% net profit margin versus negative 38. So got to really understand what this company is doing. And then lastly, receivable turnover is 11.3 versus 4.9. Chase, do they have any earnings going forward on this company?
Hey, well, I did want to kind of make a comment on it before looking at the numbers. And, we have a refiner in the portfolio, and they actually recently got rid of their limited partnership. And it's an interesting kind of caveat in the business, I guess. The limited partnership oftentimes is just using like transportation assets, and then they're paid by the big company to pay down through that limited partnership. It's a very interesting business structure, and we did refrain from the limited partnership, and that business stuck to the big company because the limited partnership, their survival depends on the big company. So I would want to, again, just caution that aspect is you really have to understand how is this company helping Phillips 66, and what is the benefit of the partnership to that business, and it could be dissolved down the road potentially as the one that we hold, it dissolved that limited partnership. But looking at the numbers here, continuing on, current price is $41.56, 52-week high, $65.23, and 52-week low, $19. So it has, more than doubled off that 52-week low. Now, if I look forward to December 2021, I see estimated earnings per share on a GAAP basis, $4.20. Gives you a target sell price of $68.04. So that still looks promising on that front. I just think you have a little bit more research to do here on the partnership. And I will caution there is different taxability with partnerships over individual equities.
Yeah. So, you got to be careful on that. So, James, I'd say do some more research on it to really understand what their partnership is. Again, we said we have a refiner. We did not ever invest in that partnership, and eventually, it was 2-3 years, I think they eventually rolled it back in the big company again. So, the numbers look pretty good on it. Again, the debt looks kind of crazy. You really, I think, have to understand it before you pull the trigger to invest in that. All righty?
Yeah, more than the numbers, I was looking at your editorial comments on partnerships versus the corporate, and you've been very forthcoming on that. And anything else you'd like to say in that regard? If you're not too busy, I'd appreciate it.
Yeah, I mean, I would just kind of add one thing more on the taxability. Oftentimes, I like to avoid partnerships because there's just so many great other opportunities where you could buy Phillips 66 and not have the headache. I mean, we work with our accountant, and I remember he actually referred a client to us, and they had so many partnerships and all the K1s. He's like, doing their taxes cost him so much money because he had to file all the K1s. So I mean, I like just the simplicity of equities over the partnerships. That's just kind of where I stand on that. I think buying Phillips 66 is just going to be probably a better option than buying the partnership.
And I'm not sure, I don't know if you know, Chase, but I'm not sure if the partnerships get the same taxability on the dividends because you get a tax break on the dividends. Do they get in the partnership? Do you know?
I'm not sure, but it could be ordinary income, as you said.
Yeah. So check with your accountant on that one because that would, an 8% dividend sounds pretty attractive, but if it's on an equity and you only pay maybe 15% tax on that versus partnership pay 100%. So that's another thing too that may, but I don't know. I'm not an accountant.
Yeah, and this kind of relates to real estate, as Warren Buffett said. Why would I buy real estate when stocks are so easy? I kind of feel the same way about the partnerships. Why would I buy partnerships when stocks are so easy?
All right, James.
Well, that's what I wanted was editorial. So thank you, gentlemen. Carry on.
All right. You're welcome. Don't be a stranger. Have a good day. Bye-bye. All right, that does open the phone line, 833-288-0973. Again, that's 833-288-0973. And Chase, before I go to the next caller, I just remembered that time goes by so quickly. We have another webinar coming up on Thursday, May 14th. And this one we're going to run until midnight because we had a lot of people go to the last one. We're going to open up the time for a little bit longer. Why would you want to listen to this webinar? Well, you're going to learn about our investment strategies. What have I done for so many years? What has been successful? And, it is funny with our strategies. It doesn't mean you're going to be right tomorrow. We're not gamblers. You're going to learn the true way on how to invest for the long term and how to invest with the least amount of risk. And also, too, what to look for when investing and what not to invest in as well. So what you got to do is sign up for the webinar. It's going to be Thursday, May 14th. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com. I believe it comes up right on when you go there. I believe that's what we have there for you. So you're going to sign up for it. And, again, that's Thursday, May 14th until midnight. You can watch that webinar. It's about an hour and 10 minutes, I think, is about how long we talk at that one.
Yeah, no, and I was going to say I'm excited about the webinar, and the first one was a pretty good success. I think this one will be even better in terms of the execution of it. But I will say, the one benefit of the quarantine here is, it kind of forced us to adapt, and it was awesome to see there was a lot of people from out of town actually register for the webinar because they couldn't come to the workshops. But they can come to the webinar, so it is kind of a big benefit there.
Yep. So, alrighty, phone number is 833-288-0973. Again, that's 833-288-0973. Get you through for that unbiased, no strings attached, final opinion about what you want to talk about. Right now, let's head up to Carlsbad and speak with Don. Don, you're in the Smart Investor with Brent Chase. How can we help you?
Yeah, good morning, guys. I would like to have you check on Honeywell. HON is the symbol.
And do you hold that?
Just recently bought some.
Yo, you just recently bought some? Okay.
Yeah, I
was gonna ask. People buy it, then they call in and see what they think about it. How long ago did you buy it?
3 days ago.
Okay. Yeah, well, I guess you wanted to do it then. Couldn't wait till Saturday and do it on Monday. So. All right, Don, let's go. Honeywell International, symbol is HON. Not a bad start. PE ratio 16.5 versus 24. Price of sales a little bit high, 2.68 versus 1.4. We do see, unfortunately, no price of tangible book value, which means that their liabilities exceed that their assets there. We also do see price of cash flow 13.5 versus 22.6. And we see a dividend yield of 2.6, and they only use 41% of their earnings to pay that out. And actually, these are numbers that are after the first quarter, so that's very helpful. We do see that the sales were down 9.9%. Industry was up 2.2%. We also see earnings per share over the last 12 months was down 1.3%, but the industry was down 40.4%. Look at the balance sheet. You got a current ratio of 1.3. That's the same as the industry. Debt to equity looking very good, 91. I say very good because the industry is at 144. Return on equity for Honeywell also very good, 33.1 versus 21.7. Net profit margin for Honeywell, 16.9% versus 5.7. That's a very good net profit margin. And we do see receivable turnover is 4.9 versus 4.8. Inventory turnover, 5.3, well above the industry at 2.7. Chase, what about the earnings going forward?
Yeah, so current price here for Honeywell, $137.25, 52-week high, $184.06, and 52-week low is $101.08. Now, unfortunately, if I look forward to December 2021, I see estimated earnings per share on a GAAP basis, $8.32. Will give us a target sell price, unfortunately, of $134.78, so below the current price there. I don't want to say it's going to go above our target sell price. I do think it'll do okay. Mm-hmm. I think it likely will exceed that just because, of course, companies are going to have to rebuild, and earnings, I think, will climb off 2020 and 2021. But I do think there are better options out there at this time.
Yeah, and I've always liked Honeywell. I think it's a pretty well-known company, good company. But again, the numbers are difficult. And right now, analysts as well are having a difficult time because companies aren't getting a lot of guidance yet because they don't know. So, I think if you held this, I would say, yeah, stay with it, which I guess now you do. But had you called today, I would have said don't buy it on Monday. But percentage-wise, Don, how much did you put in your portfolio?
Oh my gosh, I just touched. Just a very small, 2%,
okay.
1%. Yeah.
Okay, so you're not too bad. So if it does go back down, you'll be okay. And that's the thing too is that maybe it could drop back on down. We do expect volatility in this market, so you've got to watch it. If it drops back down to maybe a 110, 115, that might be the time to buy it. But call in first before you do that, all right?
Yeah, that's for sure. I think I'll wait on my buys until Monday or Tuesday instead of Fridays.
Yeah. All right, Don. Well, thanks for calling. You have a good day.
You too.
Bye-bye.
Bye.
All right, that does open the phone line, 833-288-0973. Again, that's 833-288-0973. Let's head out to or down to Bonita and speak with Scott. Scott, you're on the Smart Invest Show, Brent Chase. How can we help you?
Last week I called about Loral Space and Communication, and we both agreed the numbers are pretty nebulous. You asked me to call back this week, so what do you think now? There have been some developments since last week, too.
Unfortunately, I'm still looking at the numbers from December 31st, 2019. Do you know if they reported earnings? Do you have that, Chase, or do you know?
No, I don't know.
Yeah. Do you know if they reported that, Scott?
Don't know about that, but what I do know is there's talk of a merger with a similar company in Canada. Also, they announced a significant dividend. It's going to be paid out later this month.
Yeah, I will say, of course, our software wasn't working last week. We do have some numbers for you. I don't remember exactly what we gave you last week, but we can kind of run through these numbers for you based off of the fiscal year ending.
Yeah, I totally forgot that last week we didn't have Reuters up. This week we do, so I can give you some different numbers here. So let's take a look at Loral Space and Communications Incorporated, symbol LORL. We do see a PE ratio of 7.8 versus 18.8. Price to sales, not material, and that's very strange because you're always going to have sales versus 1.6. Price to book value, 1.38. The industry is not material. And price to cash flow, also not material versus 6 for the industry. Now here I see they don't pay a dividend, and you're talking about a special dividend here, so maybe they don't have a regular dividend. I don't see any sales revenue. I do see that their earnings per share grew by 707% year over year, well above the industry of 15. I'm seeing a current ratio of 47 versus 9. These are very strange numbers. Debt to equity is 0 versus 203. Return on equity is 27.7 versus 18. I'm even though we now have Reuters, Scott, I'm still not feeling that great with the numbers I'm getting. Do you have anything on the earnings on this side, Chase? What do you got?
Unfortunately, Reuters doesn't cover this in terms of analysts. I know when we looked at it last week, there were no analysts from Yahoo Finance either. So I do know it is a very small company, and it was actually a really good week for the company. It looks like it started off the week at 15 and ended the week at $22 a share. So that did have a nice climb, but even after that, market cap still $697 million. I do think it's kind of like the Virgin Galactic. I don't know if they're in the same type of field. I don't think they're doing space travel. It sounds like I think they do satellites or something. Mm-hmm. But it just kind of, I think, is a space play that people, it could bid up and it could go up like crazy like Virgin Galactic did. Or you just never know what's going to happen with it, especially with the limited amount of resources this company has. So it's a gamble at this time, and I think, it could do very, very well, or it could do very, very unwell, especially, as you said, if they do merge with another company, they get bought out, it'd do great. But, again, big gamble there.
Yeah, as Chase says, I think it's a high-risk buy here because you just don't have enough to kind of deal with, and it could do extremely well on it. But it'd be one in our firm that we'd stay away from. If we don't have all the answers, as much as we can get, we stay away from those type of investments.
I will say one big benefit, no debt. Looks like they have lots of liquid assets, so I will say that is a benefit.
All right, Scott?
Very good. Thanks, gents.
All right, thanks for calling. You have a good Saturday. Bye-bye. All right, that does open the phone line, 833-288-0973. Again, that's 833-288-0973. Let's head down to Mission Valley and speak with Jennifer. Jennifer, you're on the Smart Res Show, Brent Chase. How can we help you?
Hi, guys. Thanks for taking my call. I have a question for you about Lowe's, and I've been to one of your seminars or whatever you want to call it, and I know you guys do like unemotional investing. So I had bought Lowe's when it bottomed, and so I'm up 48% right now.
Wow.
So I'm trying to decide if I should – thank you. I'm trying to decide if I should hang on to it or sell it with capital gains and all that in the mix.
That's a very smart thing because, again, you've got a great profit. Hopefully that you can hold this business for a long time, but you don't want to hold it blindly and it goes up and then it comes back down. So let's take a look at the numbers for you here on Lowe's Companies Incorporated. Symbol is LOW. Not a bad start. The PE ratio is 19 versus 20.4. Price of sales 1.1 versus 1.7. That's good. Price to book value 47 versus not material for the industry, and then price to cash flow 13.9. Also below the industry at 17.5. So based on what I'm seeing so far, the valuation ratios are not that far out of whack. We do see get a yield of 2.1% on the dividend. They use 39% of their earnings to pay that out. Sales were up, and this is for they're in a fiscal year, so these are for numbers January 31st. Sales were up 1.2%, just slightly below the industry at 1.8. However, earnings per share for Lowe's, they climbed by 95% when the industry was up 21%. Look at the balance sheet here. We got a current ratio of 1 versus 1.1 for the industry. Now, debt to equity is very strange. It's 979, which sounds extremely high, but the industry is like 8 million. So there's something going on with the debt needs. And I'm wondering if they do some type of loaning, because I know the credit cards and something. So you got to understand the balance sheet to really look closely. Is their debt a problem? Because sometimes it's not really debt they owe. It's debt that they're kind of loaning to customers to actually pay, maybe off a big projects.
Yeah, I was going to say, I know Home Depot, I don't even know if they have positive equity anymore because of that. And I know Home Depot, they loan out some things. It could be, I know Rent-A-Center as an example, and they rent out different things. That does have an impact on the balance sheet. So I would want to understand that. And I know Home Depot bought back a lot of stock, which also did influence that. I'm not too sure on Lowe's, but definitely got to understand the balance sheet. There are some big questions there.
Yeah, but also, the return on equity is 151 versus 883, so that is good, but again, strange numbers there. We do see a net profit margin for Lowe's of 8.9 versus 8.4. Nothing on receivable turnover, which is kind of strange. Inventory turnover 3.8 versus 4.1. Chase, what do you got for the earnings there?
I was going to kind of add a little anecdote here. I think this is a very interesting industry at the current time. I mean, I went to Home Depot yesterday, and I could not believe how crowded. I went after work, so it was like 5:30, and I was waiting in line to get in. There was, I don't know, probably 20 people in front of me, and then I'm waiting in line to check out, and there's these two huge lines, and I'm like, oh my gosh, everybody's at Home Depot, and I'm sure Lowe's is the same way. Actually, my girlfriend, her dad was at Lowe's while I was at Home Depot, and he has the Pro membership. He's like, I had 21 Pro members in front of me, and I had to park in a different parking lot to get to Lowe's. So I think this is more crowded than the grocery store. It is crazy. So I think that's interesting.
Everyone's doing They're all doing DIY, projects right now.
Yeah, so
or
I
DIY.
think
DIY.
Yeah, DIY. DIY. Yeah. So I think it's a very interesting industry right now. I think they're going to see some good sales growth compared to a lot of other businesses. But I do want to get back to the numbers here. Current price, $104.46. 52-week high, $126.73. 52-week low, $60. I'm guessing that's about where you bought it at, as that was the bottom. And then going forward to January 2022, I see estimated earnings per share on a GAAP basis, $7.11. That would give us a target sell price of $115.18. So we still have a little bit more room for growth here.
Okay.
But again, got to understand that balance sheet. That does scare me a little bit if you don't understand what's going on with the debt to equity there. And on the taxable side, it's hard to kind of make that justification without, of course, seeing the big picture of what the tax implications would be.
Yeah, so it's a tough decision because it looks pretty good, but again, like Chase said too, I just worry when I don't understand something, why their balance sheet is so strange. I don't know if you have a degree in accounting or not, but it's something that it's so important because you could get blindsided by not understanding something they're doing. So just be careful with it. Okay, Jennifer?
Okay. Yeah, I really appreciate it. Thank you.
All right, thanks for calling. You have a good one.
You too.
Bye-bye. All right, that does open the phone line, 833-288-0973. That's 833-288-0973. And again, we got a I almost said workshop. It's a webinar now because we don't do them personally anymore.
Workshop webinar. How about that
Workshop
one?
webinar. I like that one. Okay. That is going to be coming up very quickly on Thursday, May 14th, all the way up until midnight, because we really want to open up for people so that you have time to actually learn about investing and see how we do things. And this is actually how we manage our own portfolios, how we've been doing this for years now. But you're going to learn about all our investment strategies. We don't hold back on anything at all. We show you everything we do, why we do it, and so forth. Because the key is you got to understand it and know how to do it, and it takes a lot of time. But we show you that. Also, too, how to invest with the least amount of risk. Very important. Again, we're not talking about day-to-day, share price movement. We're talking about long-term risk. We're long-term investors. We talk about buying and owning businesses. That's what we do. And also, too, what to look for when investing. We just had a great call with Jennifer on talking about, you got to understand what's going on with the debt to equity. How can that be so strange? What about the intangible assets? What is their debt like? You've got to understand all this stuff. We'll talk about that. It's all free for you, but what you have to do is sign up. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com. It is a free webinar, but you have to sign up. And again, it's going to be all day, I believe, on May 14th. We're doing all day, right?
All day.
All day, yeah, all day on May 14th. So whatever your schedule is, you can tune in about an hour and 10 minutes, and you'll learn how we invest our clients' money. So again, smartinvesting2000.com. It's so funny. I'm so used to doing the workshops. I want to get with the phone number, but the phone number does no good if we know the phone number. You got to go sign up for it.
Yeah, I got to go register there online. So make sure you do that. But I was just kind of thinking when we were looking at these numbers here and talking to the different callers is, this is really a very interesting earnings season. It is very interesting. The reason I point that out is because the numbers for the last quarter are going to be terrible.
Yes.
The numbers for the next quarter, they're going to be terrible. Many companies aren't giving guidance because they don't know what's going to happen. So, this is kind of, again, why it's so important to understand the fundamental analysis, to understand the business that you're buying. Because if you're buying a company based on, they had a terrible last quarter, you're going to find no businesses to buy. I'll tell you that right now. Or I don't want to say that. I guess you could find, probably some, like Kimberly Clark that sells toilet paper. They probably did just fine.
That's right. There's always some that did fine, yeah.
But I wouldn't buy those businesses because the valuations are too high. So, this is, again, where it comes down to understanding that business, what were earnings like before this all happened, and what will earnings be like, not next year even. I'm looking, again, not next year. I'm looking toward 2021, not this year, I guess, is what I was trying to say. Those are the numbers I want to try to start understanding, because that's where you can find some good businesses. And as we continue to point out, be very, very cautious with balance sheets. You've seen a lot of companies add debt during this time period to get through it. Those businesses that already had debt to equity of 150%, and now they have to take on more debt. Oh my gosh, that is very, very scary. Businesses that had, let's say, a debt to equity of 20% had to add debt, they'll be fine.
Are you talking about Boeing adding what? What was that? 35? Was it 35 or 45 billion?
It was a large amount. It scares me. And people are like, oh, they don't have to use the government anymore. I'm like, well, they did take on a lot of debt at the interest rate. I think it's not terrible. I think it was 4.5%, 5.5%.
I think it was 5.5 over prime or something. So it's probably between 5 and 6, I guess, is what it probably is. So it's not a terrible interest rate, but it's a lot of debt. And again, that's gonna. And again, didn't they also tap their line of credit for $10 billion as well?
I think it's $12 billion.
$12 billion. So now they have about, and they have. You know what? No, by the way, we got no callers. It's the first time since we've been on the station here that we've not had any callers. So again, if you want to call in now, you will get through 833-288-0973. Again, that's 833-288-0973. You'll be the first up for us to go to. So while I was talking, I think you pulled it up, so I'm not going to pull it up because I think did you pull up on the balance sheet? Well, we won't know yet because it's not on the balance sheet. Well,
so we see, actually, they did report, so we do have it from March 31st. So I believe that does include the $12 billion that they tapped. So their total debt right now is $38.9 billion. Before they tapped the line of credit, I believe it was $27 billion. So now that does include, as I said, the line of credit there. But now they're adding, what do we say, another $45 billion worth of debt to that $38 billion.
I think it was $45 billion. So now you're going to have debt of over $70 billion. Even at a low interest rate, that's still going to be a very high repayment that they're going to have.
That's what I was gonna, the thing that scares me about Boeing is now they will get through this coronavirus. They will get through the COVID-19. They're not going to file bankruptcy in COVID-19. They're not going to file bankruptcy within the year.
No.
My concern is now they have to repay all this debt.
Yep.
They could file bankruptcy in 3, 4, 5 years when it's like, oh, we have a lot of debt coming due.
Yep.
That could be a very big problem, especially if the 737 MAX continues to have issues and it's not getting out there. And also, you talk about airlines, their demand is not going to come back online, so they probably want to keep a smaller fleet, I think probably through 2021 maybe even, where we'll start to reutilize their entire fleet. Then they'll maybe look at adding some new planes at that time. So you're talking about very limited revenue perhaps for Boeing, which could be problematic to help pay those interest payments. And the other thing I'm concerned about, if Boeing were to have issues right now, like the government offered to help, I don't want to say bail them out, I don't like that term, but help give them some money during this time period, they're not going to give them that same offer in 5 years when everything else is resolved, and now they have this huge debt payment coming due. I'm concerned about Boeing again over a longer term. They could get through it. It could be a business that does go up very, very drastically, because I think the high was around $400. It's now around $100. So.
Yeah, I think it's like $420. It's crazy, yeah. So and it could come down even more. And on the bright side, the small bright side, they do have $15 billion in cash. So their net debt is probably around $55 billion.
But I don't remember their monthly burn rate was several billion, I thought.
Let's look at the cash flow statement real quick. I so you got a couple callers coming in, but let's look at the cash flow statement real quick to see what that looks like. Let's see, their cash flow. Yeah, so their cash flow, and this is for 3 months through March 31st. Their cash from operating activities was a negative $4.3 billion. So they are burning through cash. I think you're right. I think it was about $4 billion a month? That sounds like a high number, but it could be.
There's actually an analyst that was quoted in Forbes that does believe Boeing's monthly burn rate is $4.3 billion is the estimate, and that makes sense because this is just the operations. You then have to look into the investing activities, and then also they still have interest payments that they're going to have to make on their debt. So I mean, their monthly burn rate could be at that $4 billion rate, which is very, very scary. Even though they have $15 billion of cash, that's going to deplete that entire base. Then they have all that debt that they have to pay off.
And we've been, obviously, I don't want to say knocking Boeing, but telling people stay away from it. I remember when it fell to 380. Oh, it's a buy. It's a great buy. It's like, no, it's not a good buy yet. There could be now a time, and again, we're not going to say when or the price, but there could be a time in the future, maybe in 2021, that Boeing does become a buy.
If they show that they pay down that debt, they get out of this hurdle, and you wouldn't buy it at the absolute bottom at that time, but you avoid the risk of it going bankrupt perhaps, and you have more clarity on it, and you could still buy it at a very good level.
And I don't remember the dollar amount, but I'm pretty sure that they also have defense contracts.
They do as well.
And I don't know what percentage of them that makes up with their business, but that could also be something that kind of gets them through this, because you're right. I mean, right now airline companies are going to be kind of struggling. They're not going to say, hey, yeah, let's buy some more planes. They're going to try to get their cash flow up and going. So you may not see plane orders until, I would guess, maybe late to mid-2021. You might see that change. But, yeah, they're kind of a difficult spot right now. But it's now worth, I think, watching, but not a buy. So, and
I think there's just so many other great things out there that, you know, and people, Boeing could go back to 200. There's a lot of other companies that have a cleaner balance sheet that can double as well.
Yeah, and I would not want to say that that's going to happen. So, all right, well, let's go out to San Diego and speak with Tim. Tim, you're on the Smart Investor Show, Brent Chase. How can we help you?
Hi, I had a couple questions about two stocks. One is Aurora Cannabis out of Canada, ACB, and it's currently at 75 cents a share. They're going to maybe do a reverse split, but they're going through a lawsuit. So I wanted to get your thoughts on maybe shorting that stock, because I think the reevaluation is going to be a lot higher than it should. And then just your overall thoughts on SeaWorld, SEAS.
Okay, well, let's talk about Aurora Cannabis first. I mean, you brought up obviously two negatives. I thought, oh my gosh, it's not an investment. Then you talk about shorting it. You know, I'm not sure. I've never even thought about this. But if you short a stock and it goes bankrupt, well, I guess somebody else owns that. They still have to pay you. Yeah. So the things you laid out, and again, shorting, I will tell people, is very, very dangerous, because you have an unlimited upside. If somehow they turn it around, that stock goes from 75 cents to $2 or $3, you're going to have a terrible time.
Yeah, and the thing is, I mean, you know, actually, I had a friend that shorted Tesla, and I'm like, you know, I think that's great. I think Tesla is a terrible investment at this time. Well, as we know, Tesla went from like $375 up to $900 a share. He lost a ton of money because with shorting a stock, you have unlimited loss potential, because you have to keep getting margin calls and keep putting money in to keep that short active. And typically, the higher the price goes, there's no way it's going to go higher. Then you put more money in. You could lose a lot of money shorting. It's a very dangerous gamble. I'm scared of investing in the cannabis industry, so I think I don't want to say it could make sense as a short. It'd be like a more likely short, I guess is the way I would put it, but it still scares the heck out of me.
Yeah. I've never shorted. I'll never will short. But again, if I was going to short, based on what you said, this is a short I would perhaps do if I want to take that much risk. Does that help you out there, Tim?
Yeah, for sure. I've never shorted a stock either, and it's not going to be like a major thing. I just wanted to try and see, you know, this looked like a good short and a good possibility, you know, maybe $100, $200 just to learn how to short a stock, because I don't know how.
And I read a book many years ago about shorting, and they really get very heavy into the financial statements, kind of like what we do, the financial statements, understand the business. They're looking at the 10Q, the 10K, to really read those to understand, is there any way at all that this company can turn things around? Because if there is, they stay away from it. But it's a very long research. It's probably about what we do anyways. But if you're going to short, you're talking about looking at least 10 to 20 hours of research to really understand more about Aurora Cannabis. What is out there that you don't know is what you're kind of looking for. So, and the other one you had was SeaWorld. What was the symbol on SeaWorld?
Well, we bought the stock because the wife is like a contractor there, so we've made some money in the past off it when it was down around $12, $15 around Blackfish. We know it was at 36 before this crash. It went all the way down to 7, and we got it at 7 and at $9. And then as it rose up this week at 16, we sold our profit, kept it. It went back down to 12. So I'm just getting, like, long term, you think that company is going to be around? Are they going to go under? Is it a good time to buy it because your money could triple potentially?
Well, let's take a look at the numbers on SeaWorld Entertainment Incorporated. Symbol is SEAS. Not a bad start. You got a PE ratio of 12.5 versus 16.2, and I do see that the last reporting numbers we're talking about is still December 31st, so we don't have the most recent quarter in yet. They're probably reporting very soon. We do see price of sales looks good, 0.8 versus 2.09. Price to book value, not material, but that's the same as the industry, so it tells you they can have a lot of intangible assets probably. Price to cash flow, 4.4 versus 9. I was thinking an intangible asset is probably the shamu, the big whale. We do see that the sales are up year over year, 1.9%. That is below the industry at 5.8. Earnings per share year over year, wow, up 127 versus 16, so that's very good. The balance sheet does not look good at all. This scares me quite a bit. You got a current ratio of 0.4 versus 1.02, and debt to equity 735 versus 92. Now, holding the stock, I would tell you, go look to see what that debt is. Is it coming due quickly? How much is it? Because that's just a scary debt to equity, 735. Now, return on equity is 37.6 versus 20. Net profit margin checks in at 6.4, half the industry at 12.9. I would like to see that higher. Receivable turnover is 25.9 versus 7.4, and inventory turnover 21 versus 2.4. Chase, what about the earnings?
You know, it's kind of funny you're talking about the Shamu and being an intangible asset. I wonder if it's both, because the whale's got to be an asset, and then the name Shamu has to be the intangible asset.
You're right. You're so right on that.
It's an interesting concept. But I did also want to kind of point out some concerns was, you know, we typically like to avoid things that have concentrations in certain regions. I don't know. There are other SeaWorlds, correct?
Well, Florida, I think.
There
Florida,
is?
Yeah.
And one in Texas.
Okay, so there's a few. But the thing that does concern me there is you're putting a lot of reliability on just a couple different pieces of land, essentially, and let's say a tornado comes through and wipes out the one in Texas, or you know, we have a natural disaster, a big earthquake here in California. This company would just be decimated. I don't know if they'd be able to get out of it without filing bankruptcy. So that's a risk that you do take with this business. But looking at the numbers here going forward, current price is $14.11. 52-week high, as you said, $36.96, so still well off that. And then 52-week low, $6.75. Now, if I look forward to December 2021, I see estimated earnings per share on a GAAP basis, $1.18. That will give you a target sell price of $19.12. So the valuations look good on it. But as I said, the risks are there with the dependency. Like, I know Disney, they have Disney World and you know Disneyland, but they have so many other assets to carry them forward if theme parks do struggle, where SeaWorld, I'm not sure on that side of things.
Yeah, I don't know if they own anything else or not. That's one thing you want to check into, Tim, just to make sure. And the thing concerns me, too, is that they are in this category of big groups. When you do the shows and everything else, a lot of people. I don't know when it's going to happen. I think the talk now is September, but even that's going to be kind of slow. So I think you said you had a nice profit. Is that correct?
Yeah, it's more like, you know, maybe we're looking at it at a year and a half. So when it comes back, our sale point would be around what you said. We said $20, like in the long term. And I was just I basically take $150 because I'm a teacher. So I have a retirement and I put it into whatever, you know, I feel like the market's going to do, just to try and learn the stock game. And it just looked like a good stock over the next 18 months, knowing that it could take losses. But my concern is it going under, because they have all those animals to feed right now.
Right, and that's where you got to check that debt as well. And Chase, what was the target sell price you had?
$19.75, I want to say.
Yeah. So and don't base it just on that, because they've got a big hill to climb here. They got apparently a lot of debt. They're facing an uphill battle, as Chase said. They may only have 3 properties, and again, if something happens where I don't want to say an earthquake here in California, let's say a hurricane in Florida, that even cause them more problems. So you've got a good profit on it. I just would not feel comfortable. I'd be worried about this stock every day. Doesn't mean the stock won't go up to the $18, $20 a share, but I just think it's very risky. I'm not sure if it's worth the nerves to hold on to. Yeah. There's other ones out there I think could be better.
I hear you. Thanks, guys. I really appreciate it. It's awesome to hear some financial advice on the sports station that I love so much. Keep it up.
Well, good. Well, we're glad that you tuned in. Thank you. All right, Tim, have a good one. All right. I got to go to the next call, but I look at the shows. You know, it was like quick this hour. I mean, we wiped out the commercials. We still don't have enough time to talk to everybody.
I know. So we see John and Peggy, unfortunately, don't have time to get to you today, but make sure you call back in next week. Have some good companies that I think would be of interest to our other listeners as well.
Yeah, John had a great one on Levi. Gosh, I'd like to check them, see how they're doing.
Yeah, I know they IPO'd, was it last year?
Was it?
I don't know. Time flies. It was either last year or the year before that. So
yeah, I know. I know. It's like, that's actually 3 years ago. I mean, how fast time goes by. But yeah, that'd be a great one to kind of look at to see what they're doing. And again, it's kind of like them because of the directness that they may have, and also the retailer side. So, all right. Well, thank you for listening to Smart Investing Show. It is for information purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306. And please visit our website, smartinvesting2000.com. That's smartinvesting2000.com. And for more daily educational information, along with investment tips, go to our Facebook group page, Smart Investing with Brent Chase Wilsey. Today's show is sponsored in part by Thomson Reuters, and closing song, Frank Sinatra, My Way, is performed by local entertainer Roman Palacios. Have a great day.
This program is sponsored and produced by Wilsey Asset Management. Opinions and offers expressed during this program are not those of Intercom Communications or 97.3 The Fan.
KWFN-FM and KWFN HD1 San Diego, a radio.com sports station.
Hi, this is Manny Machado from the San Diego Padres.
Grand slam, Manny Machado. His first as a San Diego Padre. Was 4-1, now it's 8-1.
The Padres play here on 97.3 The Fan.